Hi, everyone. I'm Rick Bensignor. Today is Tuesday, March 29th, and welcome to this week's In the Know Trader Show. As we are recording late morning, stocks are bouncing again on the renewed hopes of potential and successful peace talks between Russia and Ukraine. The S&P is up about 25 points. Yields are falling today down to the 10 years down to 2.44%. Oil taking a hit on same type related peace type news, down $3. It was down about $6 earlier, so it's bounced somewhat. Bitcoin is pretty flat on the day. It was down about 1,000 earlier. The dollar is getting whacked down 80 pips or so. And it's getting hit for the same reason gold is getting hit, but right now, you're not seeing gold and dollar go opposite directions as you normally do. You're actually seeing them go in the same direction. Gold off about $30. It was down probably 50 or so this morning. And same type thing, this, peace talks are shifting people's psychology about the potential length of the war and what might happen. So too early to know for sure if anything's going to come from it, but certainly you're getting some interest in investors adjusting positions because of, again, potential peace. What we have on tap today in Trader Education, we're going to talk about when your trade goes, whoops, that didn't go the way I thought it would. So we'll talk about that. In our market overview, we'll take a look at the QQQ, the US 10-year, and Cathy Woods ARK fund, ARKK. And then we'll get to the tech sector, which we really didn't have time last week to do. So we will go through all of these names. These are probably the top, 12 names or so in the XLK. So that's what we've got going. To sign up for my weekly ETF Tactical Trader Report or the monthly 7-Eleven reports, go to inthenowtrader.com and go to the sign up tab. In the monthly 7-Eleven report, we put this together as a way of outperforming the S&P. That's the goal, outperform the S&P. We put you in no more than 7 of the 11 macro spider economic ETFs like XLK, XLB, XLE, XLF, etc. But no more than 7 of the 11 in the attempt of avoiding the underperformers. Just to give you a sense of how well this is done. In the month of February, well, we'll have new updates in a few days when this month is over, but we outperformed by 82 bips in February. Since our fiscal year began, which is every August 1st, we are ahead of the S&P by 2.22%. And since we started this in August 1st of 2020, so in 19 months, we are outperforming the S&P by an incredible 5.67%. So instead of buying SPYs, we're telling you we can do better than SPYs in active management. To give you a sense of how good we're doing through ups and downs in the market, with our outperformance of 5.67%, that puts us in what would be the top 10% of all active money managers. And again, we're not managing your money. That's, you're doing. We're just telling you where to be. So we are not presently, it may be something I do down the road, but we are not presently actually managing your money, but we simply tell you which ETFs to be in and in what percentage allocation. And it is working and working very well. Let's take a look at the macro sectors, these same 11 ETFs that we're talking about, as well as the S&P itself. On the far left side, you've got the spiders as of last night, down 3.71% on the year. Big change from last week is that you now have joining energy. 2 other sectors have finally crossed over into being up on the year. That's utilities at 3% and financials at 1.3%. You've got 3 sectors that are pretty much in line with each other, all down somewhere now around 7.5%, give or take 25 basis points. That's consumer discretionary, technology, and real estate. The worst performer, of course, is communication services. Facebook is the biggest name there, and of course, it's been having a tough year, so it's down almost 3 times what the S&P is down on the year. But of note, given the significant surge we've seen over the last few weeks in stocks, is the fact that we finally have a couple other sectors that are up on the year. So let's talk about what happens when your trade goes very unexpected to where you thought it would. And this can happen sometimes right from the start of the day. In fact, let's take something like the S&Ps for an example, where they opened at 45. Oh, well, that's last night. That's futures. So, all right, futures are up about 36. Very quickly, they were up about 50 today. And from 50, they were only up, not that, I don't know, within the last half hour, they were probably up only about 20 points. So you might have bought the open saying, wow, we've got great news. The shorts are, are squeezed. We've got them on the run. And all of a sudden you buy the open thinking we're going to still go higher. And right away, the S&Ps are, 30 handles in your face. And you're saying, boy, did I do this right or not? And it all, of course, depends upon your time frame. But many times we get into something where we've done our homework. We put our trade on, and for whatever reason, it simply goes completely against the direction we thought it would. So we're a buyer, and it goes down in our face instantly. We could be selling something, and very quickly it's well higher than we sold it for. So if you were previously long, it just means you gave up. If you sold out of your position, you gave up potential profits that you could have had if you were still in it, but you certainly didn't lose money. It was just opportunity cost. But if you shorted something and it went straight up against you, then you've got decisions to make. And let's go take a look. And I've labeled them all out here, and there's probably more, but let's just go through one by one. And you don't even need to go down the list. We'll just do it one at a time. So what do you do when your trade doesn't do anything close to what you expected it to do? It's a real whoops, wow, didn't expect that. So here are some choices, and depending upon, again, your circumstances, your time frame, and what you intended for in the first place will determine how you handle it. But it's worth talking about, because every person who trades the market faces these questions with some frequency. So choice A, give it time to develop. If you're buying a stock and intending to hold it 6 months, a year or so, this is a kind of longer term fundamental and or technical call, but not something that's immediately set out to be a quick trade. What do you do if it goes against you from the day you put it on? And one thing is to give it time to develop, which means, okay, so you didn't do great on your initial timing. You're buying this $30 stock, but you think it's going to 45 over time. And the fact that it's trading, at 29, it down over 3% in your face the day you bought it. Okay, so you screwed up on your timing. But if that's within the realm of, let's say your stop's down at 25, so you're risking $5 to make 15. Okay, so you've lost $1 of the 5 after the first day. It's not, you're in that case, you're going to give it time to develop, and your timing was just off on your entry. But in the bigger picture, it's still within the realm of everything you thought of, and that's fine. So yeah, you give it time to develop in that case, because it's a longer term position. What happens if it meant to be a trade and you were buying something at 30, looking for 32.5, and the day you buy it at 30, it goes to 29? I wouldn't look at that the same way. I was looking for 2.5 points. It's already 1 against me. That's significant enough that it makes me think about, what do I really give this time to develop or not? Or how much time what happens if tomorrow it's down another $1? Am I going to stick with it? So I think you have to analyze it in response to what you're trying, your trading time frame, as well as what were you looking for in the first place. Secondly, could you just recognize that your timing was off and you exit the trade? Well, yeah, that's certainly a very possible answer. Tough to do, because you have to simply admit you're wrong, and not only admit you're wrong, but then act upon it. But if you realize that this is just the wrong thing, I screwed up, whatever it was, I didn't get this right, and you take your loss, yes, you've locked in your loss. And if the next day or next 3 days it comes back, you go, why did it get out? But you also depending upon how precise you were trying to be with your entry and your timing, if you immediately get slapped from what you did, then your entry and your timing was wrong. And if that was a short-term trade, then yeah, you might be right to simply take things off. And again, I'm not saying that's the easiest thing to do because you are simply immediately acting and recognizing you made a mistake and then following through to get out. Not so easy to do mentally, but many times the right thing to do. Choice C, take half off or do something defensive. So if you're long and it's not working right away, yeah, take half off. And by taking half off, you're reducing your downside risk. You're also, of course, reducing what you can make if it moves higher. And if you sold that $30 stock at 28, then you need 32 just to get even. So you're definitely limiting your upside, but you're limiting your downside. And limiting your downside is often a very smart thing to do when you think about long-term trading and the most important thing any person can do, which is to focus on long-term survivability and to always be there to have enough funds to play and never let yourself get knocked out because a position is too big and then you just let it go. So a lot of times I will take half off, recognizing I've made a mistake, maybe not fully saying that I'm not giving it any time to develop because it's quickly in my face. But a lot of times I will take half off, and often when I get break even, I then will raise my sell stop. Break even meaning, let's say in this example, I buy a stock at 30, it goes to 28, I sell half, it now rallies, it goes to 32. I'm now at break even. So I need above 32 to start making money on that. In that case, I will generally raise my sell stop up to 30, saying if this gets back beneath where I bought it, I'm out. Another choice, put this into the quote investment category in your head. So you put on a trade, it was meant to be a trade, it's not working, so you go, what the hell, I'll just hold this for the long term. That's what most people do because they hate to admit they're wrong. So they just say, all right, well, my timing was off. Let's just hold on to this for a long time. Eventually it should come back. The stock market rallies over time. That's one thing you could do. Is it generally a smart thing? No. I have a friend who is long some marijuana related stocks, and they're trading at less than 10% of where he bought them. But once it started going against him, he said, well, what the hell, we'll hold on to these. Well, obviously, it can be extremely costly versus just recognizing you made a mistake and taking your loss from the first place. Another choice, hope that it comes back. Hoping is something people do, but it should not be part of your trading repertoire. It should not be part of how you think about things. You put on trades because you're confident that what you're doing is correct. You don't just shoot from the hip, so because you're not going to have a lot of confidence if you don't put the work in beforehand. But if you do your analysis and you say, and you, let's say, buy a stock, I assume you're buying the stock because you're confident it's going to go higher. If it ends up not going higher, hoping that it'll go higher is not going to change anything other than potentially delay you getting out. So, hope. There are times in life you want to have hope, and you need to have hope, but generally it's not part of successful trading in the market. Hope belongs more to emotions and things that happen in life where you're hoping for better times, hoping for good health, etc. Generally, it's not hoping that a stock moves higher. Another choice, double down. So you bought the stock at 30, it's trading 28. You still have a $45 target. Nothing's changed. Do you buy more? And a lot of people do. They average down. I generally don't. And that's just a personal preference on my part in the sense that I don't like it. If my initial analysis was wrong, I generally don't want to keep adding to analysis that was wrong just because the stock is cheaper. There's a reason it didn't work. I'm more comfortable adding to a winner than I am to adding to a loser. And then another choice, which I think any person should do, is keep a journal of what didn't go right and why it didn't go right, and see, by writing these down, see if you have a particular pattern that's not working for you. The more you kind of recognize why you do what you do in the market, and this should go for winning trades too. You should see what worked for you as well as what didn't work for you. And just the same way some people journal their lives and every day write a diary, it's not a bad idea to do the same for your individual investments, to get to recognize the patterns that work for you as well as the ones that don't. So those are just a few of my thoughts on what happens when a trade doesn't go your way. Take it for what you want to. Let's get to this week's charts. Here is the Dow, the diamonds. So this is the ETF tracking the Dow. On a daily chart, I am going to highlight here because it's lost a little bit, but you'll see, here was the sequential downside reading. The S&P actually got it a day or two later, calling for the bottom. We've had obviously a very significant move to the upside, including today's move, which gapped above the top of the cloud. And a lot of people would say that's particularly bullish. What I do want you to notice, and this is different because the pattern here actually, well, we'll see it when we get to the Qs. The Qs in the S&Ps yesterday made a setup 9 count. This did not. Let's see, 1, 2, 3, 4. Yeah, because this day here, March 23rd, actually closed lower than the close from 4 days earlier. It killed the setup count going higher. The Qs did not, the S&Ps did not. Notice that we're getting very close to the TDST line. That's the highest high in this 9 count down. That's where this blue line is, that's dotted. And it just so happens to coincide where the lagging line would hit the bottom of its cloud above it. So anything near 354-ish, and we got close to that today, the high is 353.71. Anything in that area is decent resistance. And I would look for a pullback. Number two is, notice, as good as today looks, right now, you've got a negative price candle in the sense that the current price is less than the opening price. And that means you've got real selling going on, right? Professionals are selling, the retail bought the open, and the short's getting squeezed still of the buyers. And you're still seeing, though, some real distribution by institutions. So that's, something to be mindful of here if you are, especially if you're particularly bullish. Here's the Qs on a weekly chart. I'll flip it to a daily in a second. So we had the 9 down, the setup 9 down, 9 weeks in a row that the Friday close was less than the close from 4 weeks prior. That bottom of the market, bar 8, was actually the lowest low. We hit the bottom of the cloud 3 weeks out of those 4. We've now come back above the top end of the cloud. That's potentially bullish. Notice the bottom Bollinger Band is flattening out, so it's lost its downward slope. So, this puts us much more into neutral territory. We have moved above the top of the cloud. That's good. We're just above the middle Bollinger Band. Is there a chance we go, higher and test the highs, maybe even exceed them? Sure, it's possible. Does this want to make me be an active buyer right here, right now? It does not. And if I switch this to a daily chart, here's yesterday's setup 9 count. Today we're at the top of the cloud and stalling. So we know that there should be some selling here. We're against virtually what the highs were in that first February bounce. So, we've got resistance right here. So one of the reasons I'm not jumping to buy today's, 40-point opening move in the S&P. But definitely you had the 13.9 on the bottom, triple bottom here in the Qs at the lows. So lots of reasons to have, and we showed you in real time that was the time and place to be buying. What else do we have? The let's look at the TNX. So here's the weekly chart of the US 10-year. At the start of the year, when I did my 2022 outlook, I had 2 upside targets. One was 2.16%. These are trading targets. The other was 2.5%. You can see why we've got 2.5% propulsion full exhaustion level here, just beneath or just about where we are, the TDST line up here. So this box in and around 2.5% important. We could slide up to 262 now, 2.62, which is the near-term propulsion level. The inverted head and shoulders measures up to 3.25%, which happens to be the last high made before the market dove to its all-time lows. So those are targets for this year, but I do think we probably spend some time up here consolidating the gains. And let's look at ARKK, because we'll focus today a little bit on kind of the tech space. So notice the last few weeks after the bottom was made, we went right to the conversion line. Last week, we closed on the conversion line. This week, we made a low and a trading higher. So we're going to get a little near-term resistance just above. But the longer we can stay above the conversion line, the better chance we have to rally up to the baseline. And the baseline will start falling when we count back 26 bars and we start taking out higher prices that are the highs of any like intermediate move, because this is the midpoint of the most recent 26 bars, right? So if we count back and we start dropping out higher prices, then whatever highs we see, as long as, you know, this stays the high in there, it's good. Then this will stay the same price. But once we start dropping those out over time, this level will go down. In the meantime, we're seeing a potential. We're very close to a crossover in the MACD. We know we could pause here. If you get through here with any bit of a zip, you know, we next target the baseline up to the propulsion exhaustion level. So, you know, finally, this is starting to look a little more interesting. But am I buyer right now? No, we're too close to initial resistance. Let's take a look at Apple, and we'll go through as many of these tech names as possible. So Apple was much stronger than other stocks. Tech stocks never got down to the cloud the way the Qs did. We're not far from all-time highs, which are 180, just about 183. There's still some upside targets here before we get to even higher targets, but obviously still one of the best names out there. In general, I mean, I've held Apple for years, and not any of this pullback got me to sell out in order to buy back more. It's in a taxable account, and I don't want to sell Apple and then be forced to hold for 31 days before I could come back in. So generally, it's something I hold on to for long time. Microsoft, much weaker chart. In this case, we came down, touched the cloud, did the 9. This looks a lot like the Qs did. And then has recouped. So, you know, this was a much better idea to buy than Apple was on its bottom, because you couldn't recognize the bottom as clearly as you could in this. So upside targets are near virtually all-time highs. You see the measurements here. These are propulsion signals that are still active. NVIDIA set up 9 count 1 week off of the low. Then we came back and tested it. Basically, you had, there we go, 1, 2, 3, 4 weekly lows, all virtually in the same place, and then shot up a month ago and just keeps moving. So this actually bottomed a little bit before some of the other stuff did, but you know, impressive move. It's through its downtrend line. You're going to get a little consolidation up into that 300 level, because that's really kind of in and around there. $20 or so either side is where it broke down from. Visa in the XLK. But often people think of this as a financial stock, but it's officially categorized as a tech stock. So lows against January 2021 lows. We're in the cloud now. We had bounced to the top. We came out through the bottom. This could easily get through the top of the cloud and get back up towards the 250 range, which is right around a test of the highs. Tough to know what to do with here, because we are kind of towards the higher end of the trading range. So, you know, I wouldn't be a buyer here. Mastercard, similar type thing against those January 2021 lows is where we bounced this year. This has been sideways really from all the way back to October of 2020. Upside targets are 40, start kind of at 406 and then above. And if this ends up being a sideways move that really moves higher, then there's after this sideways type move, this could really explode to the upside. If getting up to 507 is a possibility, then you could, in theory, play for that with maybe some long-term leaps or something like that. AVGO, Broadcom, one of the better looking charts. Again, held way above its cloud, about to get another positive cross, stalling a little bit here, make new highs, targets all the way up at 774 and change. We're going to finish up. I'll do two more names. Adobe, weaker chart, lagging line held against the bottom of its cloud so far. You could, especially you get back above this 474 level on Friday closes, you could right away get up to 513 to all the way up to the bottom of the cloud. So this is a name that potentially is a good one to think about. And the last one we will do, let me just quickly look through everything, is let's do PayPal. No. Let's do something even Intel. Name out of favor for a long time, right? This thing's gone nowhere, but 13 on and near the lows. It's come back still. I mean, this is kind of dead money. I'd buy a pullback here, risking those lows to get towards the top end of the range. That's it. Hope you enjoyed this week's show. I'm Rick Bensignor. Thanks for listening to In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.